Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by hitting the subscribe button, and feel free to leave your comments. All right, let's check the analysis.
All right, let's look at the tape. Friday, January 30, 2026. Strategy Inc., ticker MSTR, closes the week while fighting to find a floor, trading in a consolidated tight range between 143.19 and 149.71. The volume on the penultimate day of the month, January 29th, was aggressive. 22.56 million shares traded. That significantly clears the 30-day average of 18.82 million. So we are looking at a massive structural correction from the mid-2025 highs of 457.22. The question we're facing today is not just about price action. It's about the validity of a whole financial model. Is this drawdown a catastrophic failure of the torque mechanism, or is the market currently mispricing the most aggressive execution of the 42-42 plan that we've seen today? I'm here representing the view that the sovereign corporate treasury is intact and, frankly, functioning exactly as designed.
And I am here to argue that the machine is stalling. The premium to net asset value is collapsing. The technicals are, for all intents and purposes, broken, and the so-called infinite money glitch is running into the hard wall of market reality.
Then let's get into it. You're looking at the price chart and seeing a disaster. I'm looking at the balance sheet and seeing a fortress. But I want to hear your case first. Why do you believe the model has actually broken?
It's not a matter of belief, it's a matter of arithmetic. If you look at the technical damage inflicted on this stock throughout January 2026, it is exhibiting the classic signs of a broken momentum trade. As of this close, the price is stuck firmly below the 50-day simple moving average, deviating by over 11%, and more alarmingly, it is trading 51.26% below the 200-day SMA. That is not a correction. That is a regime change.
Technicals are backwards looking.
They tell you where the liquidity is, and right now, the liquidity is exiting. The entire thesis of Strategy Inc. for the last 5 years has been torque. The idea that you get volatility 2 to 3 times that of Bitcoin on the upside. But that torque works both ways. While Bitcoin retreated to test that $84,000 to $92,000 range, MSTR didn't just retreat, it collapsed. But the most damning metric isn't the raw price, it's the premium. The whole infinite money engine relies on trading at a premium to the net asset value, the MNAV, of the Bitcoin it holds. Late January reports are showing us something we haven't seen in a long time. The stock is flirting with discount territory, trading between 0.94 and 1.05 times MNAV. If MSTR cannot trade at a premium, the ability to raise accretive capital simply evaporates. If you can't sell stock for more than the Bitcoin is worth, the flywheel stops spinning.
See, this is where you are confusing market sentiment with operational execution. You say the flywheel stops spinning if the premium compresses. The data says otherwise. We are in the middle of this valuation crisis you're describing, and yet, look at what the company actually did between January 20th and January 25th.
They sold into a falling knife.
They executed. In that 5-day window, Strategy Inc. sold approximately 1.57 million shares of its Class A common stock. They raised $257 million in net proceeds. And what did they do with it? They didn't sit on it. They didn't buy back stock to prop up the price. No, they immediately deployed it to acquire 2,932 Bitcoin at an average price of $90,061. This brings the total holdings to 712,647 BTC. This is the 42-42 plan in action. The target is $84 billion in capital raises. They are using the at-the-market or ATM program to capture Bitcoin yield. The strategy is to accrete Bitcoin per share. If they can issue shares and buy Bitcoin and the Bitcoin per share ratio goes up, the model works. The fiat price of the stock on January 30th it's frankly irrelevant to the long-term solvency of the Treasury.
I'm sorry, but you cannot say the stock price is irrelevant when the stock is the very currency being used to buy the asset. You're describing the mechanics of the raise, but you're ignoring the market's appetite for that raise. And we have to talk about the correlation with prediction markets, specifically Polymarket, because it's giving us a signal that the institutional whales are de-risking.
Polymarket is a gambling venue for speculators. It doesn't dictate corporate treasury policy.
It dictates sentiment, and sentiment drives the premium. Look at the correlation on January 29th. The stock crashed nearly 10% in a single session. Why? Well, exactly at that moment, the polymarket contract Bitcoin to hit $100,000 by February 1, 2026, collapsed. At the start of the year, that probability was 35%. As of January 30th, it is sitting at 6%. The market realized the breakout just wasn't happening.
Short-term noise.
It's not just noise. It's a signal of what the smart money is doing. Institutional players are using these prediction markets to hedge. They are betting against the near-term breakout. If the probability of 100K Bitcoin drops to single digits, the torque premium in MSTR evaporates because investors no longer need to pay up for leveraged exposure to a rocket ship that isn't launching. The ATM raise you're celebrating? That relies on bullish sentiment. You can't just keep issuing $8 billion worth of stock, which is the capacity they have left, into a market that thinks Bitcoin is going to chop sideways or drop to 85K.
Actually, that is exactly when you want to execute. You mentioned they have $8.17 billion in available capacity for Class A common stock issuance. That is dry powder. You focus on the window of January 29th. I focus on the horizon. The company isn't just relying on common stock anymore. They have shifted to permanent capital, the perpetual preferred stock. They sold over 70,000 shares of STRC preferred stock recently. And why does that matter? Because unlike the convertible bonds of the 2020 to 2024 era, preferred stock has no maturity date. There is no cliff where they have to pay back the principal. They have locked in that capital forever. So while the speculators on Polymarket are crying because they missed a February 1st deadline, the company is structuring a balance sheet that can wait a decade.
Permanent capital sounds great in the slide deck. But let's talk about who is actually holding the bag right now. We need to discuss the market structure, specifically the dark pools. The level of off-exchange trading it's flashing a massive warning sign.
That's standard institutional volume.
It is not standard. On January 28th, the off-exchange short volume ratio was 46.74%. Nearly half of the shorting activity is happening in dark pools. This isn't retail traders on Robinhood. These are institutions hiding their directional bets. The short interest is still sitting at 12% of the float. That's roughly 31.55 million shares.
And a 12% short interest is fuel for a squeeze.
Or it's evidence of the basis trade, institutions shorting MSTR and buying spot Bitcoin to capture the arbitrage as the premium compresses. If they are shorting in dark pools, they are betting that the premium, the very thing that allows your 4242 plan to function, is going to zero. They are betting that MSTR just becomes a wrapper for Bitcoin, minus fees.
Okay, if the institutions are so bearish, if the smart money in the dark pools is betting against the house, then explain the insider activity. Explain the skin in the game.
Insider buying can be performative.
Not when you're writing checks this size. We are seeing robust insider buying in January 2026, right in the middle of this downturn. Carl J. Rickardson, a director, he bought $4.75 million worth of stock, 23,000 shares on January 12th. Jane A. Deitz, another director, purchased 89,000 shares on January 20th. The CEO, Fong Li, bought nearly $1 million worth on January 8th. While your dark pool traders are hedging and arbitrage trading, the people actually running the company who see the daily execution of the Strategy 1 software and the treasury flows, they are buying the dip. That is the ultimate vote of confidence.
I will grant you the insider buying is a positive signal, but it doesn't erase the structural opacity that is starting to creep in. You mentioned the Strategy 1 software. Let's be honest, the market cap is $46 billion. The software revenue is barely touching $474 million. The PS ratio is 99. This is not a software company, and yet the narrative is shifting to try and justify this valuation through infrastructure.
It is not a justification, it is an integration. The Strategy 1 platform is now deeply integrated with Microsoft Power BI, analysis services, and runs on AWS and Google Cloud. But more importantly, look at the custody shift. In late 2025, they moved $5.1 billion. That's 60,000 BTC from Coinbase to Fidelity custody.
And that is exactly where the transparency problem lies.
How is moving to Fidelity, one of the most trusted financial institutions on earth? a transparency problem.
Because Fidelity uses an omnibus system. Your assets are pooled. When MSTR was buying on Coinbase back in 2020, we could track the wallets, we could see the on-chain movement. Now, that $5.1 billion is in a block box, mixed with the Fidelity Wise Origin Bitcoin Fund. It obscures the on-chain movements from public view. For a company that champions verify, don't trust, this is a move back toward trust us, it's there. And when you compare this to the new entrants, MSTR looks increasingly like a legacy play. I mean, look at Bitmine Immersion. They are moving toward an ETH staking-first model. They're generating network yield. MSTR is unhedged, sitting on 712,000 BTC, paying interest on debt, and generating no native yield from the asset itself.
Bitcoin is the yield. That is the misunderstanding. You're chasing staking yields in Ethereum, taking on protocol risk, slashing risk, regulatory risk. Strategy Inc. is playing a pure scarcity game. And regarding the peer comparison, look at the miners. Marathon Digital, Riot, they're valued on hash rate. Their equipment depreciates. The difficulty adjustment works against them. MSTR is a pure capital allocation play. The move to Fidelity aligns them with the ETF ecosystem. It professionalizes the stack. It makes them the sovereign corporate treasury that other companies, like the ones attending the Bitcoin for Corporations track at the upcoming conference, will want to emulate.
Let's talk about that conference and the financials leading up to it. Because you have a major risk event on the calendar before anyone steps on stage in Vegas. February 5th, Q4 earnings.
We know the numbers.
Do we? The markets are anticipating a significant gap loss. We're talking about a $17.44 billion unrealized loss on digital assets recorded in late 2025.
That's accounting fiction. Everyone knows FASB rules on digital assets have been a mess, even with the fair value updates. That loss is non-cash.
It's a headline number that triggers algorithms. But the real risk isn't just the earnings beat or miss. It's the classification. You mentioned the Bitcoin for Corporations track. The danger is that index providers, specifically MSCI, are watching this very closely. If they decide that MSTR is no longer an operating company, but essentially an investment fund due to these massive holdings and, frankly, passive software revenue, they could exclude it from key indices. You have Vanguard holding 24 million shares, BlackRock holding 14 million. If MSCR reclassifies MSTR, the forced selling from passive flows would be catastrophic. The cash moat you talk about won't stop an index rebalancing.
But that cash moat ensures they survive the rebalancing. That is the entire point of the January 4th data. They have a $2.25 billion USD reserve. Think about that. $2.25 billion in cash. Their dividend obligations on the preferreds are roughly $879 million a year. They can sit there for 30 months, 2.5 years, paying everyone, servicing the debt without selling a single Satoshi. That is resilience. That is anti-fragile.
It's a runway, yes. But a runway to where? You're burning almost $1 billion a year in dividends just to hold the position. That is a heavy, heavy carry cost.
It's the cost of doing business when you are the largest corporate holder of the scarcest asset in the universe. And the catalyst to reignite the narrative is right there. Strategy World 2026, February 23rd to 26. Michael Saylor's keynote is Freedom by Design. This isn't just about software anymore. It's about positioning Bitcoin as a national reserve asset.
Politics and speeches don't fix a broken chart.
They drive the narrative that drives the premium. You have networking scheduled with Cash App, with Mara. This ecosystem is solidifying around MSTR as the leader. The drop to 140 is an opportunity to reload before the narrative shifts back to the institution-led era.
Or it is the final warning that the institution-led era has decided to bypass MSTR entirely. If institutions can buy the ETF with zero fees, or buy the miners for beta, why do they need to pay a premium for MSTR? The poly market odds dropping to 6% tell me the torque is exhausted. The dark pool shorting at 46% tells me the pros are betting on compression. The discount to NAV is the smoking gun. The 42-42 plan requires a premium to work. Without it, you are just diluting shareholders to buy an asset they could buy themselves cheaper.
They can't buy it with the leverage we offer. They can't buy it with the accretive yield we generate.
The disconnect between price and value right now is the same disconnect we saw in 2022 and in 2024. Every time the premium collapses, the experts say the model is dead. And every time the company executes, buys more Bitcoin, now 712,647 of them, and achieves escape velocity. The shift to preferred stock, that was the checkmate. They have permanent capital. They have the cash runway. They have the Bitcoin.
They have the Bitcoin, but they also have the gravity of the market. We are at a stalemate. The earnings on February 5th will strip away the narrative and show us the raw math. If the BTC yield KPI, which sits at 22.8%, starts to waver, or if that gap loss scares off the passive flows, this 140 level won't hold.
Keynote reignites the fervor, and that $8 billion in dry powder is deployed into a recovering Bitcoin market. 140 will look like a gift.
That is the gamble, the torque trap, or the capital machine.
We will find out in February.
Indeed we will.
Thank you for watching the video. Remember to subscribe to the Stock Market Palantir channel for more stock analysis like this, and leave your comments below. See ya.